Why shorts can't kill Rezolve AI. RZLV options tell the story. 1. The backdrop. Why RZLV trades so much volume. 50-day average volume approaching 24 million shares is extreme relative to fundamentals, and it's not coming from long-only investors. This is being driven by high short interest, 15.75%, very high options activity, event driven volatility, financing, earnings, guidance resets, and market makers actively hedging. In names like this, options volume creates stock volume, not the other way around. Every time traders buy calls or puts, market makers hedge deltas by buying or shorting shares. Those hedges must be constantly adjusted as price moves. That's why it trades tens of millions of shares even when nothing happens. 2. The financing. Why it matters more than people think. $250 million oversubscribed financing. This does two critical things simultaneously. 1. Caps bankruptcy or dilution risk. 2. Invalidates the strongest bearish thesis. But it also creates a known supply overhang, eventually, and a volatility anchor. Price swings, but survival risk drops. That's perfect for volatility traders, market makers, and structured option strategies. This is why implied volatility is still 130.74%. Uncertainty shifted from will they survive to how big can this get? 3. What the call open interest is telling you. May 15th, 2026, OTM calls. Strike 5,580, delta 0.59, key meaning near the money, dealer sensitive. $4, 13,374, delta 0.52, massive positioning zone. $4.50, 2,169, delta 0.46, speculative upside. $5, 12,362, delta 0.41, lottery convex upside. What traders are doing: accumulating long dated upside exposure, positioning for multi quarter growth narrative, betting volatility stays elevated. What market makers must do: these deltas, zero point 0.4 to zero point 0.6, force market makers to buy shares. As price rises, delta increases, more buying. This creates positive gamma above $4. Translation: upside moves accelerate once price pushes into $4 to $5. 4. What the put open interest is telling you. May 15th, 2026, OTM puts. Strike $3.50, 2,124, delta minus 0.41, probability in the money 69%. $4, 12,356, delta minus 0.49, probability in the money 76%. This is not panic hedging, it's structured downside positioning. Key insight: put OI roughly mirrors call OI at $4. That implies straddles, strangles, or volatility selling. Institutions are trading range and volatility, not direction. Market makers are short puts and short calls, hedge by shorting above, buying below, actively pin price near high OI strikes. $4 is a magnet level. 5. Why implied volatility stays so high, 130% plus. Normally, after financing and earnings, IV collapses. Here, it doesn't, because short interest remains elevated, options positioning is heavy and long dated, directional conviction is split, and market makers are paid to stay flexible, not directional. This creates violent intraday moves, fast reversals, and high churn volume. That explains the absurd daily liquidity. 6. So, what are traders versus market makers actually doing? Traders, long dated calls for convex upside, long dated puts for tail risk, volatility bets, not binary bets, expect big moves, not straight lines. Market makers, short volatility, delta hedging aggressively, buying shares on dips, selling shares into rips, trying to pin price near $4. Shorts, trapped structurally but not yet forced, waiting for dilution events, narrative fatigue, and volatility exhaustion. 7. The big picture. This is the key takeaway. This is not a normal stock right now. RZLV is functioning as a volatility instrument, a gamma driven trading vehicle, and a capitalized growth optionality play. Upside risk exists because call OI plus short interest plus dealer hedging equals squeeze fuel. Downside is buffered because balance sheet risk is gone, puts absorb panic selling, and dealers buy dips to hedge. In plain English, traders are betting on big future outcomes. Market makers are farming volatility, shorts are no longer in control, and price action will remain violent and noisy.
Okay, so as things stand right now, lower prices are expected for our ZLV going all the way towards March of, if not end of February of this year, end of February, towards the end of February. Um, yeah, but in the interim, there's a chance that it might pick up a bounce towards the 29th of January. Okay. Projections, do we have anything here? 3.64, yeah, slight upper projections, 3.64, 3.89. Let's see what we have on it. Okay, this is 21 day moving average. It's trending, it's trending. Okay, trend mode is from 0.35, 0.25. So this 40-day moving average, 20-day, 21-day moving average is rising. Its momentum is 35 cents every day. 35 cents every day. It's a theoretical indication, because obviously, um, on a daily basis, things can change. Okay, so positions opened all the way back to 21 days ago are currently in profits. Okay, so let's see now. Let's have a look at the market grid. Sorry, it's 10 day moving average price pressure momentum. Okay, for the in the case of a 10-day moving average, 10 positions open 10 days ago are not in profit. You can see here this is negative. It's dropping at a pace of the downward momentum is $1.46 every day. Okay, so positions opened all the way back then are not in profit. And momentum is expected to continue to weaken based on its 10-day moving average up till the 24th of February. Okay, so yeah, that's in a nutshell. That's what's going on. Underlying trend still remains strongly bullish, regardless. Yeah, still remains strongly bullish. Okay, thank you very much for watching this video.